$80 billion. Gone. Just like that, vanished from U.S. Treasury holdings. China dropped its U.S. Treasury bonds to the lowest level since 2009. Not a typo, not a rumor. Official U.S. Treasury Department data confirmed this. And simultaneously, Beijing was loading up on gold at record pace. This is not portfolio management. This is a financial declaration of intent. If you care about your savings, mortgage, or retirement, keep watching. And if you haven't already, subscribe to Finance Insight right now. This channel breaks down exactly what the big money doesn't want explained. Let's get into the numbers, because the numbers tell the real story here. China once held over $1.3 trillion in U.S. Treasury bonds. $1.3 trillion. That peak was back in 2013, and since then the decline has been relentless. By December 2024, China's holdings had fallen to just $759 billion total. 9 out of 12 months in 2024 saw China reduce its treasury exposure significantly. That's not an accident. That's a strategy being executed with surgical precision now. The U.S. Treasury Department confirmed the December drop of $9.6 billion officially. But December wasn't the only month. The trend stretches back years and years. And here's where it gets really interesting from a geopolitical standpoint entirely. In the same period, China was selling bonds. It was aggressively buying gold instead. The People's Bank of China resumed gold purchases in November 2024 after pausing. Before that pause, it had gone on an 18-month straight gold buying spree. By September 2025, China's official gold holdings had reached 2,303 tons total. That's 7.7% of China's total foreign reserves sitting in physical gold now. The message from Beijing to Washington couldn't be clearer if they sent a letter. We are moving away from your paper. We are moving into hard assets permanently. Now let's talk about what happens when China sells and what it actually means. U.S. Treasury bonds are essentially IOUs. America borrows. The world lends back. When the world's second largest economy starts lending less, borrowing costs rise fast. That hits the federal deficit. That hits mortgages. That hits your monthly payments directly. In April 2025, the bond market gave everyone a preview of exactly this scenario. The 10-year Treasury yield spiked to 4.5% during that single chaotic week. Just days earlier, it had been sitting comfortably below 4%. No alarm bells. The spike was so sharp, Deutsche Bank publicly warned U.S. bonds were losing haven status. Think about that for a second. U.S. Treasuries are supposed to be the world's safest asset. The entire global financial system is built on that assumption of American creditworthiness. When that assumption starts cracking, everything built on top of it shakes violently too. Ed Yardeni of Yardeni Research put it plainly in a public note to clients directly. Fixed income investors are beginning to worry about Chinese and foreign treasury selling. That fear alone is enough to move markets. Perception drives capital flows in finance always. Now let's zoom out and understand why China is doing this and why now specifically. The trade war between the US and China didn't start with one tariff announcement, obviously. It's been building since at least 2018 when the first round of tariffs got introduced loudly. But 2025 brought it to a boiling point nobody on Wall Street could ignore any longer. U.S. tariffs on Chinese imports were hiked to 145%, 145%. China responded by raising its tariffs on American goods to 125% immediately back. This isn't a disagreement about soybeans. This is an economic war being fought in real time. And in every war, both sides look for pressure points they can squeeze without shooting. China's $759 billion in U.S. Treasury holdings is one of the most powerful pressure points existing. Analysts at SMBC Nikko Securities in Tokyo flagged it directly to Bloomberg's financial reporters. Ataru Okamura wrote that China may be selling treasuries in direct retaliation against U.S. policy. BNP Paribas Wealth Management's Grace Tam told Reuters markets are now genuinely concerned. Countries could use treasury holdings as a retaliation tool, and that concern is fully justified. When bond yields spike, the White House notices immediately. They always watch the bond market. Kevin Hassett from the National Economic Council admitted the bond market influenced tariff decisions. Scott Bessent kept a close eye on bond yields throughout the most volatile trading period. The White House even celebrated publicly when yields briefly dipped below 4% temporarily. That celebration tells you everything. Bond yields are the Trump administration's economic scoreboard, and China knows exactly which scoreboard to manipulate for maximum political leverage and pressure. Here's the mechanism that every American should understand regardless of investment knowledge level. When foreign holders sell U.S. Treasuries, demand for those bonds drops significantly and immediately. When demand drops, the U.S. government has to offer higher yields to attract new buyers. Higher yields mean higher borrowing costs across the entire economy without exception or escape. Mortgages go up, credit card rates go up, car loans go up, business loans follow. The Federal Reserve watches this from the sidelines, trapped between inflation fears and recession risk. Jerome Powell himself acknowledged the risk publicly, using the term stagflation in official Fed communications. Stagflation means rising prices and slowing growth at the same time, the worst combination possible financially. The bond market's behavior in April 2025 was so unusual it spooked even seasoned Wall Street veterans. Stocks and bonds selling off together simultaneously is historically rare and extremely alarming to watch. That pattern only previously appeared during the 2008 financial crisis and the 2020 pandemic shock. Now it's appearing again, driven by geopolitics and deliberate financial strategy from Beijing's policymakers. And here's the detail that makes this even more layered than the headlines suggest right now. Some analysts argue China isn't fully dumping bonds. It's rerouting them through custodian accounts. Belgium and Luxembourg, tiny European countries, have mysteriously seen massive Treasury holdings increases recently. Brad Setzer at the Council on Foreign Relations has noted China uses offshore custodians regularly. The Treasury's own FAQ admits custodial data doesn't always reflect true beneficial ownership of bonds. So the real picture might be even larger than official Chinese holdings data currently reveals. Either way, whether direct selling or strategic rerouting, the intent and direction remain crystal clear. China is diversifying away from dollar-denominated assets at a pace that has no modern precedent. Gold reserves, alternative currencies, belt and road financial infrastructure. All of it points one direction. The BRIC nations, Brazil, Russia, India, China, are collectively stepping back from U.S. treasuries now. Brazil's holdings dropped from $229 billion in late 2024 to $168 billion by November 2025, significantly. India's dropped from $234 billion to $186.5 billion over the same 12-month comparison period entirely. This isn't a China story. This is a global creditor confidence story unfolding in slow motion. And the slow motion part is what makes it genuinely dangerous for ordinary investors and policymakers alike. The dollar's reserve share has quietly dropped from 71% to 57% total. That erosion happened over 24 years, but the pace is now accelerating noticeably. IMF COFR data confirmed the dollar's reserve share hit a two-decade low recently. JP Morgan Research noted foreign ownership of U.S. treasuries dropped to just 30%. That's down from over 50% during the 2008 global financial crisis peak. Think about what that number means for a country borrowing at America's current scale. The U.S. national debt crossed $36 trillion in November 2024 and kept climbing fast. By September 2025, total federal debt had ballooned further to $37.6 trillion confirmed. The U.S. government added $2.2 trillion in new debt in fiscal year 2025 alone. That's $6.12 billion borrowed every single day, $255 million every single hour nonstop. And the interest bill on that debt? It hit $1 trillion in fiscal year 2025. $1 trillion in interest, more than the entire U.S. defense budget that year. Interest payments became the second largest government expenditure behind only Social Security itself. The Congressional Budget Office projects interest costs will reach $2.1 trillion annually by 2036. That means every American household effectively owes $284,940 toward the national debt right now. This is the fiscal backdrop against which China is executing its treasury selling strategy. Beijing doesn't need to collapse the bond market to inflict serious and lasting damage. It just needs to keep reducing demand enough to keep yields elevated and painful. And elevated yields flow directly into the wallets of ordinary Americans every single month. When Treasury yields rise, mortgage rates follow almost immediately with very little delay. Credit card interest rates rise, auto loan rates rise, student loan refinancing gets harder. Every financial product tied to Treasury yields becomes more expensive for real everyday people. The Government Accountability Office has documented this chain clearly in multiple public reports issued. Higher government borrowing crowds out private investment, lowers wages, and reduces long-term growth significantly. This isn't academic theory from a textbook. Americans are already feeling it in their budgets. Now here's the uncomfortable question that Wall Street analysts are quietly debating among themselves. What happens if China decides to stop gradually reducing and starts aggressively selling instead? China still holds somewhere in the range of $759 billion to nearly $900 billion combined. Even the conservative figure represents enormous market-moving firepower if deployed with deliberate intention strategically. SMBC Nikko's strategist Ataru Okamura flagged this scenario explicitly to Bloomberg in April 2025. The concern isn't just China, it's the signal China's behavior sends to every other holder. When the second largest economy demonstrates it's comfortable reducing dollar exposure, others take notice. Saudi Arabia, which built its entire wealth model on petrodollars, is watching very carefully. ASEAN nations agreed in May 2025 to develop local currency settlement frameworks for trade. BRICS expanded its membership to include Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE. The bloc collectively represents a growing share of global trade moving outside dollar channels entirely. Over 20% of global oil trading is now done in non-dollar contracts, according to data. That number was essentially zero just 2 years ago. The shift is accelerating dramatically fast. The petrodollar system, the backbone of dollar demand since 1974, faces real structural erosion now. If oil trades in yuan, euros, or rupees, central banks need fewer dollars in reserves. Fewer dollars needed means fewer U.S. Treasuries purchased. The feedback loop is self-reinforcing and dangerous. Charles Schwab confirmed the dollar's reserve share dropped from 65% in 2005 to 57% by 2025. That 20-year decline is now compressing into a much faster trajectory under tariff and sanctions pressure. Goldman Sachs Asset Management acknowledged investors are reassessing hedge ratios on U.S. assets globally now. Even modest increases in currency hedging by pension funds translates into incremental dollar selling over time. The dollar's safe haven status, once automatic and unquestioned, is now being openly debated in boardrooms. Deutsche Bank said it plainly in April 2025. U.S. Treasuries may be losing their traditional haven status. That sentence from a major global bank should have made far bigger headlines than it did. Gold told the whole story in 2025 without any political spin or narrative filter applied. Gold set 53 new all-time highs during 2025, alone according to World Gold Council data confirmed. The LBMA benchmark price averaged $3,131 per ounce for the full year, up 44% annually. Central banks globally purchased 863 tons of gold in 2025, well above the decade's historical average. A World Gold Council survey found 95% of central banks expected gold reserves to increase further. A record 43% said they plan to actively increase their own gold holdings that year. Not a single central bank surveyed said it planned to reduce gold holdings at all. That's not a coincidence. That's a coordinated institution-level exit from dollar-centric reserve management globally. And while all this unfolds, the U.S. fiscal position offers absolutely no cushion for comfort. The budget deficit in fiscal year 2025 hit $1.8 trillion, according to official GAO reporting. Debt is projected to reach 120% of GDP by 2035 under current policy trajectories. An alternative scenario with persistent high yields puts that number at 134% of GDP instead. The Congressional Budget Office projects $16.2 trillion in interest payments over just the next decade alone. America is essentially running a credit card it can never fully pay off, and creditors know it. Now, what does all of this mean for someone watching at home and wondering what to do? First, understand that this shift is structural and multi-decade. It won't reverse in one election cycle. Second, rising yields are not going away quickly as long as foreign demand remains structurally suppressed. Third, gold's sustained record performance is the market's honest verdict on dollar confidence right now. Fourth, diversification isn't just for institutional investors anymore. The macro risk is reaching household balance sheets. Fifth, watch the 10-year Treasury yield as your real-time economic war scoreboard every single week. When it spikes without an obvious domestic trigger, foreign selling pressure is almost certainly part of it. The January 2025 debt limit was reinstated at $36.1 trillion, then raised to $41.1 trillion by July. America added fiscal headroom not by fixing the problem, but by raising the ceiling again permanently. That's not fiscal management. That's kicking a growing financial grenade further down a narrowing road. Meanwhile, China holds $3.3 trillion in total foreign exchange reserves as of mid-2025 confirmed data. It has the firepower to keep rotating out of dollars gradually for years without any drama. No dramatic announcement needed, no single headline moment, just persistent, strategic pressure applied with patience consistently. That patience is itself a weapon. Markets hate slow-moving structural threats more than fast, visible shocks. The 2008 crisis was fast and visible. Everyone mobilized. Governments responded. Liquidity flooded the system immediately. A slow erosion of dollar demand is harder to fight because there's no clear moment of crisis. No one rings a bell when reserve currency dominance shifts. It happens in quarterly data releases quietly. The dollar's share going from 71 to 57% took 24 years and barely made front pages. The next 14% decline could happen considerably faster, given the geopolitical acceleration currently underway now. This is the real story behind the $80 billion in bond sales, not the number itself. The number is the symptom. The strategy behind it is the diagnosis every investor needs to understand. China is not trying to crash the dollar tomorrow. It's trying to make America pay more to borrow. Every basis point of extra yield is billions. An additional interest expense the U.S. taxpayer carries permanently. That's a slow financial siege, and by every available measure, it is already meaningfully underway right now. If this video made you think differently about what's actually happening in global finance today, subscribe. Hit that subscribe button on Finance Insight right now and never miss analysis that actually matters. And drop a comment below. Do you think the dollar will hold its reserve status through 2030? The debate is real. The stakes are enormous, and your perspective belongs in this conversation today.